Welcome back to the channel, everyone. Today I want to talk about how a number of different hedge funds are currently in the process of going bankrupt after creating billions of synthetic shares. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, I want to start by showing you this video of Doug Cifu, the CEO of Virtu, who just admitted to the creation of synthetic shares. I want to talk about how the creation of these synthetic shares has effectively led to infinite liquidity, and how the Fed and the US Treasury is effectively backstopping this infinite liquidity and supporting it and helping to provide it. But also how this backstopping is becoming more and more stressed and how it's leading to a number of different hedge funds that are going to end up going bankrupt. So Roy tweeted this video and said the wholesalers are effectively providing infinite liquidity. Here's Doug Cifu, the CEO of a liquidity fairy, aka Virtu Financial. He said it sounds like he's admitting to the potential of infinite synthetic shares. They just hide or cover the share dilution with derivatives. So let's hear what Doug Cifu actually had to say on the matter.
What we call size improvement, and we've been very upfront and very transparent about providing that level of data. So what that means is, in the 8,000 names, to the extent there's not liquidity on a lit exchange, fundamentally the wholesalers are providing infinite liquidity at the NBBO or the inside price. So if we get an order for 1,000 shares in Reg NMS stock that no one's ever heard of, and there's 200 shares on NASDAQ in New York, we fill out 1,000 shares at that inside price. That's meaningful liquidity. 55% of the orders that we received, Bob, we provide size improvement. In a complete, as he calls it, an auction environment, who's going to provide that? The liquidity.
So right there, Doug Cifu just admitted to creating synthetic shares. If there's only 200 shares available to purchase, but somebody places an order for 1,000 shares, they effectively create 800 additional shares to satisfy that order. And he says that's a good thing because they're creating meaningful liquidity and helping orders to be filled and helping transactions to take place. But as Ashley says, the stock market doesn't need a liquidity fairy. It needs stock prices that are determined based on supply and demand. If you're trying to buy 1,000 shares, but only 200 are available at the price you want to pay, then the price should increase until there is a willing seller. For example, if a fund is trying to buy 1 million shares of AMC at $12 per share, but there's only a few thousand shares available at $12,000 per share, then instead of creating additional synthetic shares, the price should just move upwards until the buy order is completely filled. And as Ashley says, infinite shares only dilute the price and effectively end up seller boxing genuine American companies. And Rocket Astronaut tweeted saying, I get infinite liquidity to keep the wheels turning, effectively naked shorting under the guise of liquidity. But the problem comes when they take your money and never actually go and buy or find or locate those shares. This is why I believe there's a massive amount of synthetic or naked shares. And he said it's why once they're in such a deep, massive buried situation, aka when they've created so many synthetic shares that they can't actually get out from underneath the problem, they instead put the companies under bankruptcy so they never actually have to find those shares. Obviously, if you've created too many synthetic shares and you can't resolve the problem, the hedgies so far are taking the opinion of, well, let's just seller box the company, let's just bankrupt it, let's get it delisted from the exchange, then nobody will want to buy the stock and we won't have to locate the shares or resolve the problem of synthetic shares. And he said that's why the shorts pile in as well. They know a company is getting seller boxed, so it's effectively an easy win or an easy short for them. And he said that's effectively why it's a massive theft, fraud, Ponzi scheme. But their time is coming. Rizzo also answers the question of where exactly these market makers are getting the money to support and to help create all of these synthetic shares. Rizzo has said that infinite liquidity, meaning that hedge funds and asset management companies, aka BlackRock and Vanguard, are being provided infinite liquidity by the Federal Reserve and the US Treasury via repos, reverse repos, derivatives, treasury bills, CDOs, securitization, mortgage-backed securities, and more. He said it's the biggest Ponzi, Fugazi, slush fund, Cayman Islands shadow banking scheme you've ever seen. But at the same time, we know the Fed and we know that these hedge funds are becoming more and more stressed. In each of the last 3 or the last 4 days, we've seen the reverse repo facility setting a new all-time high every single day. We're also seeing inflation continuing to spiral out of control. Inflation isn't reducing as expected or as told to us by the Fed. Instead, inflation is continuing to rise. And guys, if you didn't already know, Moomoo don't accept payment for order flow because they don't clear through clearinghouses like Apex Brokers. They actually have their own clearinghouse, Virtu, that does not accept payment for order flow and clears the orders separately away from Citadel. Therefore, Moomoo is brilliant for buying those AMC shares. And if you sign up to Moomoo right now using the link in the description below, you can currently get 5 free stocks worth up to $2,500 each. That's a total of up to $12,500 in free stocks and a free share of Lucid guaranteed on top of that. And this is why many hedge funds are steadily going bankrupt and why some hedge funds are about to close shop. So let's hear this interview from Liz Claman about a number of different hedge funds and why they're about to go bankrupt.
How much worse is this going to get? I mean, these are just a couple of names that have reported their very bad performance.
Yeah, I think it's going to get a lot worse, Liz, because what I'm astounded by is the lack of risk discipline in these hedge funds. We talk about asset bubbles in meme stocks. We talk about bubbles in SPACs. We talk about bubbles in cryptocurrency. But these are supposed to be some of the most sophisticated investors. And the reason people give 2% management fee and 20% incentive fee is to manage the risk in down markets. What we've seen is that the large hedge funds, long-short equity hedge funds, have got into SPAC investing, have got into private equity investing, got into venture capital investing, which is not their traditional expertise. And they're borrowing money. So when the market turns, they're not able to be flexible and move quickly.
What amazes me is people, as you say, are paying these guys to be much smarter than the rest of us in the room. And look what is happening here. When the markets flip a switch and the tables do turn, that's when, as Buffett likes to say, you see who's been swimming naked as the tide goes out. Well, I know you can't name names, but what types of bets have gone so wrong way that we will start to see some hedge funds that have made those bets maybe go under?
And I think Raj has really hit the nail on the head here. He said that these hedge funds have been investing in crypto, they've been investing in SPACs, they've been taking risky bets trying to short meme stocks, all while borrowing billions and billions and billions of dollars from these major banks and from the Fed in terms of reverse repos. They've made these risky bets, they've lost money in SPACs, they've lost money in crypto, they've lost money shorting the meme stocks, and they don't have enough money to pay back these loans and to pay back the cash that they've borrowed. And that is effectively why these hedge funds are stuck and they can't escape. The market has fallen against them, meme stocks have run against them as well, and they're just stuck and they can't get out. And that's why we're seeing some hedge funds like Melvin Capital already closing their doors, some hedge funds like Tiger Global Management being down over 50%, and we're now seeing even more funds like Maverick and Lone Pine both being down over 30% this year. Both of these hedge funds have likely been stung by the rout in technology stocks and also been stung by other risky bets like crypto, SPACs and shorting meme stocks. It says Lee and Steve's hedge funds have tumbled by roughly a third this year, joining other Tiger Cubs stung by the slide in technology stocks. Maverick Capital dropped 32.5% through May. Among its largest first quarter bets were stakes in South Korean e-commerce giant and Amazon. Both wagers would have been among its biggest losers if the firm continued to hold the stocks through last month. Two stocks it held in the first quarter, Workday and Shopify, have been among the hardest hit, dropping 43% and 73% respectively. So we're seeing more and more and more hedge funds losing 30%, 50% or even more and closing their doors. And it now seems like they're also trying to suck even more money from crypto. Average Ape tweeted saying ETH or Ethereum got the knife. They are in desperate need of liquidity. Over the last 24 hours, Ethereum has dropped by 12%. Over the last month, it's down by 23% as well in total. This goes to show that these hedge funds are scrambling for their money back in cash to meet these margin requirements. They were selling off Bitcoin in the past, now they're starting to sell off Ethereum and other smaller crypto coins. And as Nazim tweeted, all of these sources are pointing to one thing, which is the fact that Citadel Securities is slowly also going bankrupt. And as the Cabesi letter tweeted, they said May CPI showing inflation at a fresh 40-year high of 8.6% was the Fed's worst nightmare. They've said signs of inflation peaking in April were wrong, and now the Fed must raise rates at least 8 times. They've said the only way to control inflation will be a Fed-induced recession. This can't end well. Obviously, inflation is continuing to spiral out of control, and therefore the Fed needs to continue raising rates, and raising rates faster and more dramatically in order to fight inflation. But obviously raising these rates so fast and so dramatically is going to cause a stock market crash and will effectively cause a Fed-induced recession. Obviously, as all of these large blue chip stocks end up crashing, these hedge funds are going to struggle more and more and more to meet their margin requirements, and we're going to see more and more large hedge funds like Melvin Capital closing their doors. And don't forget, these large funds that are currently shorting AMC, even though they've shorted billions of synthetic shares, which is obviously worth billions and billions of dollars, that's only a fairly small percentage of their overall portfolio. Many of these large funds may only have, say, 10% of their overall fund size shorting AMC, and the remaining 90% is still very long on the market, long on tech stocks, and long on the S&P 500. These funds are obviously getting closer and closer and closer to that margin call, as their overall 90% of their entire fund portfolio is steadily shrinking. And when they do end up getting that entire fund-wide margin call, they'll be forced to sell off their long positions and, most importantly, cover their short positions and close out of their AMC shorts. And obviously when these the largest of the large funds are forced to close out of their AMC shorts while being liquidated, it will cause the AMC squeeze. They'll be forced to not only buy back millions of AMC shares, but forced to buy back billions of AMC shares. And obviously when these large funds start placing market buy orders for billions of AMC shares right in the open market, AMC will squeeze to unimaginable highs. So guys, be sure to let me know what you think down in the comments below, and also be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.